Today we are discussing the most recent asset allocation research note prepared by the Escala investment team, and with me today I have Giselle Roux, our Chief Investment Officer.
Hi Ben.
Welcome, Giselle. Now, we've seen a sharp recovery in equity markets in the first quarter of 2019. Has this forced a change in any way to your asset allocation models?
We haven't changed anything particularly, albeit that we do recognise that what was intended to be sort of a 12-month run at equities from the beginning of the year has taken, as you said, quite a sharp upward lift, and we'd probably expect the markets to take a breather at some time. We do need the earnings profile to now lift to compensate for the rally in valuations. And it's similar in fixed interest markets. We've seen spreads come down in credit markets. We've seen the bond market rally on the face of yield movement. As we see economic improvements coming through, and the data is pointing to that now starting to really happen, we will probably see the yields widen again, but importantly, earnings will probably lag for a period as a catch-up from the previous quarter. So we do anticipate a soft patch, but not such that we'd see a big drawdown.
Sure. Many of our clients, particularly in retirement, are looking for extra income to help fund their lifestyle. What types of income strategies should they be looking at, particularly in this low interest rate environment?
And given the potential changes to franking credits here, which will just exacerbate that debate. And frankly, it's a global debate. You're seeing everywhere in the world people struggling with institutional markets as more and more people enter retirement phase to generate income. There is no magic solution. We would continue to advocate a mix of product solutions, if you like. So we've got our separately managed account, Martin Curry, the manager, doing equity income. They had a poor year last year, but this year they're actually lifted once again. So we'd still encourage people to maintain the faith in their capacity to deliver that income stream. And then in the fixed income markets, we're looking for a variety of alternative styles of investment. For example, we've recently recommended changing to a cap stream product, which has got a higher income stream. We have some of the private lending, which, depending on investor appetite, is available. So we encourage people to have a broad mix of income-producing assets.
Sure. The CIA team are continually looking at investment opportunities. Are there any contrarian plays you're considering at the moment?
Yes, contrarian, we need to be quite confident that we think things are not what everybody else believes them to be, and we're respectful of the opinion of markets. We have two probably where we consider ourselves to be somewhat contrarian. The first is that we think the resource sector will continue to perform relatively well, whereas most are calling for the commodity cycle to dampen down iron ore and oil prices. We think they'll probably kick along a little longer. And the other side is that while the forward markets and interest rates are pricing in interest rate cuts, we frankly think they're somewhat unlikely because the economic data is not supportive of that, and we don't think central banks really want to use interest rate cuts while the economy is not entering into kind of recession or slowdown. So anything that's pricing in an interest rate cut, we would be contrarian towards those that have actually got those. We'll continue to look for other kinds of investments as well that are completely uncorrelated with equities and fixed income. They're really tough to find, particularly those that you obviously want to believe in strongly, not just because they're not correlated. But we'll continue to look for those, and that will be something that we'll continue to put forward to investors.
Great. Okay, thanks, Giselle. Thanks for tuning in, and as always, please contact your advisor to discuss the most appropriate asset allocation for you. Thank you.